Hi guys, today as you can see it's summertime here in the Netherlands. There are 30 degrees and I felt like a little bit of flowers would suit the weather. So regardless of that, today we're gonna talk about what's the right time to raise capital. I hear this question a lot of times. The reason is entrepreneurs want to know when and to focus their effort on fundraising because it's something that takes a lot of your time and energy and maybe detrimental to your business. If you divert too much of your attention to that, so want to do it right. And the answer is we should not first of all talk about what's the right time, but what's the timing of raising capital, and I'm going to explain you why in a second. uh, Truth is, at least this is my opinion, that if you're a startup you are always fundraising. Why is that? Because like when you're in business you're always selling. If you're a startup you're always fundraising, meaning that uh, if the opportunity comes along you're not going to say no, right, to an investment. So you're always fundraising, but there is a time, there are different timing on how much where to put your effort on that and how to juggle that. So I like to define two different types of actions during the fundraising. That is, when you are in a sprint and when you are not, right? uh, Being in a sprint means that you are pushing to get the run closed, and this is something that takes up to 50%, even more of your time while doing that. So that's when you need to give it 100%, and most likely means diverting your attention from other things. When you're not sprinting you are probably jogging, and this part can be as important as a sprint, because if you do not prepare for the sprint then you're not going to be successful, and you can do as many sprints as you want, they're not going to be successful. So let me break down when you are sprinting and when you are jogging, or if you want to use a metaphor, when you are in high season and low season, right? So let's start with the low season or the jogging part, that is when you're not sprinting, right? So when are you not sprinting? There are two main ways to determine that. The first is external, that is, you should not sprint when the time is not right for the investors, meaning December. December is not a good month to sprint because there are the Christmas vacations, other things, the end of the year. So if your aim is to get the deal done in December, it's not going to happen. And the other time of the year where things slow down a lot is the period July August, at least in Europe. In the States could be more September, but I would say in between July and August that's where things slow down, and where a lot of investors may say, okay, let's talk when I'm back from vacation. So you don't want that, right? If you're sprinting you don't want that, and I'm going to tell you, and in a second you're going to see why. So these are the two part. This is the first part, when the season is not right, and then the other reason why not to sprint is when you are not ready as a company. This means that you still have to work on the fundamentals of your firm, meaning that you can be too early stage, and other aspects that depend on the type of your business. So this aspect is going to be explained in a second when I'm going to tell you what to do when you are not sprinting, so when you're jogging. When you're jogging, that is when you are not investing more than 10% of your time in fundraising, you should be working on the core of your business, right? So the fundamentals. What that means is that you should first of all identify the KPIs you want to focus on, and make sure that the organization works toward them, right? Measure them, see the improvements or work on the improvements. And by fundamentals I mean that you should be able to build an organization that is sustainable, right? You should build a growth engine that allows resources to be invested, and the output being larger than the resources you invested, right? So this depends on the kind of company or business you are into. The KPI can be up to you. If it's a SaaS company, it can be like the typical retention, metrics. But I would like to summarize the key aspects of that as being your acquisition cost for the customer should be lower than the lifetime value of the customer. And in my opinion, that is true for any type of business model, right? So does that mean that you should not lose money or you should be profitable? No, it does not mean that. The fundamentals look at the relative of the value, not on the total, right? Let's make an example. So you can still be cash flow negative, but having your fundamentals, that is your customer acquisition cost, lower than the return or the lifetime value of that customer, right? So if you have that, it means that the more capital, the more resources you pour into the process of acquiring customers, the more profit or the more margin you're going to have, right? So it makes sense at this stage to even invest more than what you earn, and as a matter of consequence have a negative cash flow, because you are postponing the moment of profitability to the point where the profit, instead of being 10, is 1,000 or even larger, right? So when you're building a company, when you're building like your fundamentals, you should think about your business as being a company that is for profit as an option, meaning that it's there on the table if you stop the growth, but you chose, because you have the opportunity, to reinvest as much as possible in making more and more profit, right? So if you had that, then you have a solid proposition that investors will like. The second thing you should do when jogging regards identifying the investors you want to talk with and see which are the best ones for you when you're going to sprint, right? This is similar to the process of in the sales, that is qualifying your leads, right? So how do you qualify your leads? Well, you need to talk to them, right? Truth is, investors, especially when we're talking about VC firms, they receive so many propositions, so many companies, they don't have time to just talk to you. So what's the best way to get feedback and learn from them, who are the best people? Well, you should pretend you're raising capital. And as a matter of fact, they are going to assume you are, right? So just get this straight in your head, that they're going to assume that you're raising capital whenever you contact them, because that's the matter of their business, right? They are there to invest in opportunities. So even if you say you are not raising capital, then it even turns against you, because they're like, what, why is this guy wasting my time, right? Are we talking business or not? So get a deck ready, a teaser deck. Don't spend too much time on that. Just get the deck ready. Look for introductions, contact them, and the purpose you have in mind is not to sprint. You're not sprinting. You're not trying to raise capital to get the deal closed, but you're trying to learn as much as possible. That is qualifying your leads, right? So, and qualifying your leads involves qualifying the right company, because maybe they're simply not into the type of business you are after, and sometimes you don't know, right? Sometimes you simply don't, even if you read the website. And qualifying the person you're going to talk with, right? So most likely you have to address principles. It's very difficult to get to partner level, but hey, build sort of positive and engaging conversation with the person you're talking with, and only focus on those that give you like a positive vibe. This is quite important. So to get honest feedback it's not asking them to give me feedback. This is not gonna work. Just ask them the questions like, are you interested in the field I am active? Do you think that an amount of 1 million is within your target of investment? What is your thesis of investment, right? And that depends a lot also on the type of investors they have in the fund, right? Are they investing for their own money, or they are like an historical VC that invests based on the power law, or are they investing like a governmental institutional money that is somehow constrained to the corporate goals or the corporate behind them, right? So try to get that straight, because sometimes you do not see that from the website, and know what they're looking for. This is crucial for you when you're going to sprint. Also, I forgot to mention that it's also good to try different approaches while doing that, different teasers, just one slide, just the other. Fine-tune your proposition in a way that whenever you're going to sprint, you're going to get immediately their attention, because you know that that's what they're looking for, right? You can even try different emails, etc., etc., etc. If you get a call, better. Do your best, and know in your head that you're not sprinting, so lower your expectations. But hey, in that case, it can even work out that they are like, oh wow, we really like this company, we want to invest. In that case, well, all of a sudden you're in sprinting mode, but at least it's them deciding that you're in sprinting mode and not you. So in that case, it's I would say a lucky shot, but hey, it can happen, and I really hope that it's going to happen to you. Now let's get to the sprinting part. Uh, so sprint means that you're all in a sudden the time you spend on talking to VCs and looking for money goes from 10% or even lower to 50% or even higher probably. I would say 50% is a realistic estimate. Um, so is this sustainable every day of the year? Of course not, and this is why we're talking about sprints. So when is the time to sprint, right? Um, I like to think that the time is when you cannot cope with the demand you are generating. That's the ideal scenario, right? So you are, you are simply not able to serve all the customers you're getting. The growth is extraordinary in users, in revenues, in other in any aspect, and you just need like more capital to keep the engine running and running faster, right? So this is like the ideal position for any startup, and I understand it's very very difficult to find that, but hey, it's a it's human psychology that the less you need something, the more you get it, or you get it offered, right? So you should be in a position, if you work on your fundamentals, where you potentially do not need uh, a VC to invest or an investor to pour in some more capital, right? If you work on your financials, it means that if you stop reinvesting, you are profitable in a sudden, right? And we get back to the point of profitability as an option. So your proposition is going to be, hey, invest in this company not because I need capital to survive or to build something, or say to build a brand new market proposition or whatever it is, but because I have already like a good market proposition that is running and can run faster, can expand faster, can reach global scale. This is when every investor will have like, is gonna have eyes wide open and say, okay, I'm listening. This is something for me. I'm listening, and this is true for anybody. Again, it's simply human psychology. So that's the ideal scenario. Truth is, a lot of entrepreneurs do not have such a luxury situation. So should you not try? No, of course you should try. This is entrepreneurship. We're talking about making it no matter what, no matter the adversities. So just keep in mind that it may be harder, but hey, great entrepreneurs come out in the moment of difficulties, right? So you can pull it off even in the worst market conditions ever. Truth is, be aware that you are in that situation, that you are in a weak position, and in the end of the day, when you're asking for something, you are always in a weaker position, and that's why I say, if you don't need something, then you get it offered. Um, but hey, I've seen plenty of founders that have been successful, and they just had to go through uh, like a dip in their curve, and after that decide to grow again. So it may happen to everybody. After determining what's the right moment for you to sprint, what it's important is that define an internal deadline of how long the sprint is going to go for. And the reason is quite simple. If the sprint becomes 2 months, 3 months, 4 months, then it's not a sprint anymore, it's a marathon. You don't want that. You cannot afford to spend 50% of your time on doing fundraising. It gets frustrating, energy draining, your business is gonna suffer. You don't want to do that. So, just limit yourself to, I would say, 4 to 5 weeks where you go, all in, right? So you set a time beyond which you're gonna reconsider your strategy. You're gonna reconsider your time. So after you have a deadline, pick up the list of companies that you contacted while jogging, and give them priority. Start with those that are less likely to invest, so you can still fine tune the last things in your proposition, and then go higher and higher and contact all of them. I would say email is the preferred mean. Make it like a killer intro email or killer first email saying clearly what you want and what you're looking for, because hey, they are there to give you their opinion, and they're gonna be pretty quick in replying to you if you are clear what you want, right? So you just want a yes or no, and make sure you get that right. So identify them, make an email, get ready to follow up with them, call them up, make sure you keep the momentum up, because it's also important that if they feel like you are, let the time pass, maybe it's okay, like, what, I'm gonna look at that next week, I'm gonna let you know, and then for 3 weeks they don't hear from you, they're gonna forget. It's simple, right? Make sure they don't forget, keep the momentum higher. And there's also like, they also have this kind of pattern recognition, that is, if they see founders that act in a certain way, then they know that those founders are probably going through something very cool, right? So elements you need to make your proposition clear: how much you're raising, what's the valuation or valuation range you're willing to negotiate. I need to read this. You need to have like a clear strategy with the potential for a huge exit. This is very important. Like a lot of firms invest based on the power law, meaning they want to see companies that can reach 1 billion valuation. So make sure that you have this broad vision out there, and combine that with your fundamentals that you have been working on for the past months. Your proposition looks all of a sudden very, very solid, right? So make a teaser deck, right? As we saw for the jogging part, you need to have that. But now it's also time to make like a full deck, because whenever they're gonna invite you to pitch, or they want to see more information from you, you need to have that ready, or you need to be ready to do it overnight or whenever you have time, right? So get it straight, and make like a killer first email. That's very important. You have like just 1 minute, maybe less, of their attention. So make sure that they understand exactly what you want. They open your deck. They have probably the first 30 seconds where they still listen to you. But if you lose them there, then they may pass, even though you are like an amazing opportunity. And also, of course, I can make a list with all the contacts that you developed. Try to tailor the message and the email to the company that you are approaching, and hopefully you have enough elements after the jogging part to know exactly how to do that. The final part is for how long should you do this, or for how, when should you stop? You should stop when your chances are getting smaller by the day, and I would say, again, maximum 5 weeks. If at that point you still have like something pending, but like you probably went through like 70% of your list, and you got rejected, which is normal. Hey, keep in mind that 90% of VCs are going to reject you. Well, you maybe want to reconsider the sprint, because you're losing momentum. If you are able to nail some 5 weeks to get like at least a few meetings in person, and or phone calls, or or even presentations in front of the team or the VC, right? After that, I would say that's a threshold. After that, I would say another 1 to maximum 2 months to get to a term sheet. But hey, if after 5 weeks you don't even get to pitch in person, then quit the sprint. Take your time, refocus your energy, do it again later on. Hope this is clear. Hope you like that, and I'll see you in the next video.